Now we're going to take a look at one of the questions in Appendix 12-A. Let's look at the first one, Exercise 1. So the company is considering introducing a new product, and we are given some information on that product. Using the absorption costing approach to cost plus pricing, compute the markup the company will have to use to achieve the desired ROI. So that formula is given on page 580. Excuse me. So the formula, required ROI, return on investment, and we're given that here, is 8%, times the amount of the investment, and we're given $400,000 as the amount. So the required ROI times the investment plus selling and administrative expenses, and we're given that as $40,000 here. You divide that by unit sales of 10,000 times unit product cost of $16. So you just work that out and you get a markup of 45%. Now in part 2, it says, assume that the $16 unit price here, that it includes $3 per unit for fixed manufacturing overhead based on producing and selling 10,000 units per year. So $3 of that is fixed. Also assume that $26,000 of the total selling and administrative expenses of the 40 here, $26,000 is fixed. The remainder is variable. Use the total variable costing approach to calculate the markup the company will have to use to achieve the desired ROI. So again, the formula is required ROI times the amount of the investment, so 8% times 400,000, plus total fixed expenses. So the total fixed expenses, we know one part is 26,000, and the other is $3 of that 16 is fixed, so $3 times 10,000 units. So 26,000, and the overhead is $3 fixed times the 10,000 units is 30,000. So these are the fixed expenses. Then we divide that by the unit sales. So again, they're looking at 10,000 times the total unit variable cost. So now to get the variable cost of that 16, 3 was fixed, so that means we know the remaining 13. So 16 minus 3, which is a 13, is variable. And of that 40,000, we know 26 was fixed, so the remainder is variable. And then when you take those two, or well, actually, just this one here is the total. So we divide it by 10,000 units because the 16 was given as a unit cost. But this amount here, we have to take the 40 minus the 26, which is 14, and divide it by the 10,000 units, and we add those together, we get $14.40. So now we just work that equation out, and you get 61.11%, which is going to be the markup. Then in part 3, compute the target selling price per unit under each of these approaches. So under the absorption costing approach, the unit product cost was $16. The markup was 45%, so 45% of that 16 is $7.20, which gives you a selling price of $23.20. Under variable cost, the unit product cost here was only $14.40, but the markup is 61.11%, so 61.11% of that $14.40, which is $8.80, which gives you a selling price of $23.20. So it's just, for these ones here, it's just knowing, remembering the formulas. They're very similar, so just remembering the difference in both. And that's it for that question.